Good evening, ladies and gentlemen. We are about to begin the webinar. It is a pleasure to welcome each one of you for this webinar on Gift City, a global financial gateway perspective from experts. We are honored to have our partners, Gift City IFSC, the Ascent Group, PwC, SNR Associates in this initiative. It has been our endeavor at Catalyst to take the lead in exploring and expanding business opportunities. In keeping with this tradition, to my mind, this is the first webinar of its kind organized by a debenture trustee as an intermediary of SEBI on the immense opportunities for financial services opened up under the aegis of International Financial Services Center established as Gift City. We are highly obliged to our partners for their collaboration, involvement, and support. The format of this webinar has been so organized that each partner would make presentations on the respective areas of expertise. Since each aspect of the subject has been captured, it will ensure that this webinar brings forth a comprehensive view from all stakeholder perspectives. In addition, special focus will be on the potential of alternative investment funds as the driver for attracting resources for investing in productive enterprises with significant benefits to the investor that were never available before. Gift City is a world-class financial and information technology zone established to provide services in India and to the world. It has coupled with technology, finance to metamorphose into a fintech. It provides onshore talent with offshore technological and regulatory framework. It has the potential to make India a price setter in at least a few heavily traded instruments or commodities, currencies, equities, or interest rates. You may be happy to know that around 250 have registered for this webinar. This itself indicates the enormous interest generated on the subject. In the interest of professional time management, let us now embark on this journey of sharing gainful knowledge. It is my privilege to introduce the experts panelist. Mr. Sandeep Shah, Head IFSC Department, Gift City. He has been involved from the beginning of the International Financial Services Center at Gift City. He has been leading various initiatives with IFSC Authority, Ministry of Finance, RBI, SBI, and IRDAI to develop and promote IFSC globally. Also, he has been involved in suggesting budgetary support for enhancements that would whet the appetite of investors. His success is reflected in the fact that for the last 6 years, consistently, there have been positives for Gift City in budgetary announcements. Then we have Mr. Umesh Salvi, Business Head, Catalyst Trusteeship Limited. He has been a part of the trusteeship business for the last 15 years. He has executed all types of transactions and dealt with the entire gamut of related issues. He has a deep understanding of the market. He has rich hands-on experience of resolving hurdles and ensuring positive outcomes. We know him to be a forward-looking person, constantly in search of new business avenues and new solutions. His engineering background always comes to the fore, and for him, Gift City is a godsend. We have Mr. Swapnil Akut, Counsel of SNR Associates. His practice focuses on capital markets and investment funds. He also advises on a range of other matters, including fund formation, private placements, public offerings, buybacks, tender offers, and depository receipt programs. Mr. Swapnil has featured in IFLR 1000 as a notable practitioner for capital markets equity. Mr. Swapnil advises on all aspects from setting up of AIFs, funding, critical aspects of operations, and regulatory compliances. Today, he will shine light on evolution of legal landscape, typical structures, key parameters, and regulatory advantages. Mr. Balaji Subramaniam, partner from PwC. Mr. Balaji has advised on large banking, non-banking mergers and acquisition transactions in India, apart from assisting clients on niche banking and capital markets projects both in the Indian mainland and the GIFT City IFSC. Mr. Balaji advises foreign portfolio investors funds from a tax and regulatory perspective, specifically on their India entry strategy and offshore and onshore platform setup. He has been a part of the delegations discussing policy matters with Indian regulators and tax authorities. Mr. Jayesh Kaitan, Head of Sales, India, the Ascent Group. He is renowned for his in-depth knowledge of fund structuring, fund administrative services, and development of financial products for alternative investment funds. He joined as a global fund administrator, where he was instrumental for developing and promoting their private equity, venture capital, and real estate fund administration business in India. The presentations on related subjects would follow in the same sequence as the introductions. It is requested that participants may communicate their questions, queries on the chat box. It is proposed that on conclusion of the talk presentation by the expert panelist, some response slot would be allotted for clarifications, replies. It will be appreciated that due to time constraints, it may not be possible to respond to each issue raised. However, it is proposed that the response to unanswered matters would subsequently be conveyed in a couple of days. As such, do feel free to raise your doubts, requirements of additional information. So let's begin with the presentations by our expert panelists. I invite Mr. Sandeep Shah. There cannot be a better person than Sandeep Shah to guide this webinar on Gift City ecosystem, business opportunities, and regulations, as he has been playing a key role in the development of Gift City concept since its inception and ensuring that it remains aligned to international practices. Mr. Shah, you're welcome to join.
Thank you, Shashankji, and I would like to thank Catalyst for organizing this webinar on a very important topic. And we have seen a lot of interest from the fund community, especially to understand the regulations and the other aspects related to the setting up a fund in GIFT City. And we will try to cover all this today during our presentation. And I will be happy to answer some of your questions post this presentation as well. I'll share my presentation. I'll cover this entire discussion today in two parts, basically. The first part will cover mostly from the perspective of how GIFT City has evolved and the ecosystem and some of the entities which are operating today in the city. And the second part will cover from the perspective of the alternative investment fund business, how it is evolving and what are the regulatory and tax aspects for setting up fund here. So to start with, I'm sure many of you are aware about the GIFT City as a structure. So it's a greenfield smart city project, and it's located near Ahmedabad International and Domestic Airport. It is much closer to the Gandhinagar, which is the state capital. The idea is to create integrated city development. So it covers not only the commercial development, but it also has a residential and social facilities as a part of the overall ecosystem. From the beginning, we are trying to see that the regulations, the tax aspect, and again, even in the dispute resolution, we provide best of the infrastructure, whether it is regulatory or the physical infrastructure. As it was a greenfield project, we could actually experiment in some of the infrastructure facilities that we have created in the city. And we are happy to share that more than 300 entities or the companies are already operating in the zone. And some of the names like Bank of America, Standard Chartered, and from the IT companies like Oracle, TCS, they have set up their shop and they are operating in GIFT City. If we now specifically talk about the International Financial Services Center, started way back in 2015 when Ministry of Finance notified IFSC as a GIFT City as an International Financial Services Center. Earlier, as you all may be aware, the RBI, SEBI, and IRDA issued the operating guidelines for banking, insurance, and capital market vertical to operate. And subsequently, last year, Government of India notified IFSC authority, which is a unified regulatory, which regulates all the financial services business in the zone. And they are operational and they have been now regulating the financial services business in the GIFT City. Apart from banking, insurance, and capital market, now the focus has also been into the new lines of businesses. The asset management business has been growing quite fast with the regulatory and tax amendments in last 1 year. And similarly, the ancillary service providers like legal firm, accounting firm, they've also now set up their shop in GIFT City. Uh, I'm sure Balaji will cover tax aspect much more in detail, but just to give you a broad level idea, the entities in IFSC enjoys 10 years of income tax holiday on their business income, and they have flexibility to select any 10 consecutive years out of 15 years. And similarly, for the capital market players, there are other tax incentives, like there is no short-term capital gain tax, there is no long-term capital gain tax, there is a withholding tax exemption. So I think various tax incentives have been provided to ensure that the investors, foreign investors, enjoy the similar treatment that they generally enjoy in other global financial centers. As we speak today, there are more than 19 banks already operating, and including foreign banks like Standard Chartered, HSBC. They have set up their offshore banking unit. Uh, and there are two international exchanges already operating in the zone. They operate 22 hours a day, and average daily trading volume has been around more than $14 billion a day. Along with the exchanges, there are capital market intermediaries as well. More than 50 broking firms have set up their shop here, and they are providing trading platform to the foreign investors. There are more than 20 insurance firms and the ancillary service providers as well to support the overall financial services business ecosystem in GIFT City. As I mentioned about from banking, insurance, and capital market, we are also now venturing into new lines of businesses. One of them is the International Bullion Exchange, which is going to be India's first spot bullion exchange, which will come up very soon. The exchange as an entity has already been established. The other two major businesses which we are targeting is the aircraft leasing and financing business and the ship leasing and financing. Uh, as you know, the aircraft leasing business is totally today driven through other financial centers. And now with the available regulatory framework, the Indian Airlines can actually lease the aircraft through the IFSC leasing entities. And similarly, we are now trying to attract ship leasing business as well. The advantage to some of the apps which will be set up in GIFT City is that apart from the normal investment activities that they generally do, they can actually look at investing in some of these leasing companies as well going forward. We are also targeting global in-house centers basically. So for the first time, GIC has been recognized as one of the financial services activity, and now the global financial services firm, they can cater to their overseas subsidiaries or overseas branches through IFSC, and Bank of America is the first one which has set up their global in-house center today with more than 2,000 people working in the city. Now I think we can discuss more from the AIF perspective, how the ecosystem of alternate investment fund is coming up in GIFT City. So today in the GIFT City, the alternate investment fund and the manager.
Sorry to disturb you. Can you make it full screen? Your presentation, please.
You can see the full screen only from my level.
Okay, fine.
I think it's showing full screen only on the main screen. Okay,
yeah, okay.
So the alternative investment fund regime in the GIFT City, where the fund and the manager entity can be set up, and this fund is allowed to invest in all the securities in India, whether it can be under the FDI route or under the FPI route. Basically, the investors can be the foreign investors, so it can be NRI, it can be foreign individual, it can be institutions. They can invest into the fund in GIFT City. The resident investors are also permitted to invest in a fund in GIFT City under the LRS route. However, this fund, that the LRS money should be invested in the overseas market. That LRS money cannot be invested back in India. So that is the term. And in terms of the investment, I think they have opened the market for all the securities. So you can, if you can invest under debt, under equities, under the unlisted in unlisted securities. So there is no restriction in terms of investing into the market. Some of the key regulations which apply. So as a fund, you can set up under a trust structure or a company or a body corporate. If you're already registered fund manager in India with SEBI, you can also operate under a branch structure. That is something where you don't need to create a separate company. Even a branch structure can be set up and obtain the fund manager license. In terms of the investment from IFSC to India, as I mentioned, you can invest under FPI route, you can invest under foreign venture capital route and the FDI route as well. And if you are investing under FPI route, the same AIF will also obtain FPI license from SEBI. So one fund, as a fund, you will obtain license from the IFSC authority as a AIF. And if you are looking to invest in India under the FPI route, you need to obtain license from SEBI through the custodian for the FPI business. And the important part here is the overseas investments have been permitted. So you can even invest 100% of your fund in the overseas securities. So today, generally in India, when you invest overseas, there is some cap, where you cannot invest more than X percentage in the overseas securities. However, your fund in GIFT City can invest even 100% in the overseas markets. The one point I would like to highlight here is when you set up your fund or a manager entity, under the FEMA regulations, you are recognized as non-resident entity, which means you are away from the FEMA regulations and you are recognized as a non-resident entity. However, under the income tax or from the perspective of any other regulation, you are a domestic entity, but you enjoy the benefits of non-resident status under the FEMA. The minimum corpus requirements are more or less similar to what today applies in India under the SEBI regulations. The amounts have been converted into more of a dollar term. So $3 million is the minimum corpus requirement. And the sponsors contribution is basically for category 1 and category 2 fund, it's 2.5% of the corpus or $750,000, whichever is lower. And similarly, for category 3, it's 5% of the corpus or $1.5 million in the category 3, whichever is lower. So I think more or less the conditions or the requirements are similar to what today applies in India, and the amounts have been converted into the dollar terms. The three major relaxations which have been provided to the apps and which actually makes it more attractive for the offshore funds to set up in GIFT City. One is the funds have been permitted to do the leverage, as much they want. They just need to mention in the PPM document, they need to disclose it. Otherwise, there are no restriction in terms of the leverage. Second, the regulator is also permitted to do a co-investment strategy in this fund. So you can have the new investor under the co-investment route, and you can invest new units to the new investors. So that has also been permitted. And third, which is again very important, is the investment diversification norms. So when you invest in India, the diversification norms do not apply. So that gives a big relief. So it's similar to what FPI generally invest in India from the overseas market. Similarly, when they invest under FPI route in India, the investment diversification norms would not apply. We also found that the sponsors contribution requirement is something very important, where most of the times when Indian funds, when they are setting up a fund overseas, and similar to when they set up in IFSC, they need to infuse sponsors contribution. Now, because the fund in IFSC is recognized as a non-resident entity, the amount will be transferred from Indian sponsor to GIFT fund under dollar terms. So a rupee would be transferred into a dollar terms in GIFT City fund, which means you need to follow the RBI's regulations for transfer of sponsors contribution to the GIFT fund. Now, what RBI has done is they have made it under the automatic route. So if you follow the regulation 7 of the ODI, where if you have a 3 years profit record and if you are a regulated entity, you can even transfer the sponsors contribution into the GIFT fund without going through an approval route. So it can happen under the automatic route. So I think that is a big relief and the kind of ease of operation that has been provided by the regulator here. The relocation of fund has also been covered basically under the regulation as well as tax. So when you relocate your fund from any other overseas centers to GIFT IFSC, the regulatory enablement has already been provided. And similarly, there will not be any adverse tax implication when you transfer your units from overseas fund to the gift fund. I'm sure Balaji would cover the tax aspect more in detail, but I think for the people who are looking to transfer their existing funds from overseas center to the gift IFSC, the mechanism has already been provided. Broadly speaking, what you need is to set up a fund. You need a fund and the manager entity. And the fund, generally, we believe it's under a trust structure. So when the entities have been established, you apply to the two authorities, one SEZ authority and the second IFSC authority. Both the application can happen parallelly. And our experience says that both the approvals can be obtained in, say, maximum of 45 days of time, if all the documents are in order. So I think the process is quite simple, and it's many more than 20 funds have already applied, and they've got the license also in the GIFT City. I think overall, if we look at the fund business require the ecosystem as well. So the banks and the capital market players are anyway present today, but apart from that, we have the bank fund accounting players, fund administrator, the trustee service providers, custodians. They are also present today in GIFT City. So the services that you want to set up your fund here, all the service providers are available today in GIFT City. Overall, this is my last slide. It gives you a perspective about the advantages and the benefits, while the regulatory and the tax regime make it more attractive for any business to set up here. Another important aspect that we have observed is the cost of operation is quite low compared to setting up fund in any other overseas jurisdictions. So I think that is something which is driving, and you are closer to the market. So if you're looking to invest in India, instead of setting up in any other overseas jurisdiction, which is a different time zone and the regulator is also different, this gives a more comfort for funds to locate their AIF in GIFT, where you deal with the regulators within the country and you are closer to the market. So I think this makes it more attractive, and with this I'll end my presentation, and we'll be happy to answer any questions that you may have. Thank you.
Thank you, Mr. Sandeep Shah. We have one interesting question that has come about. The question is, what will be the status of carry forward losses of offshore funds in case of relocation?
So I think this is more from the tax perspective. Balaji, would you like to take that in terms of the carry forward losses? You're on mute, Balaji.
Yeah, sorry.
Or we can take this question, or we can take this question at the end of it.
Or during the tax presentation, yes.
Yes, we'll take it at that time. Thank you, Mr. Shah. With the larger picture brought before us, it is time to appreciate the actual road to be traversed to achieve the intended goal of setting up businesses. I am sure we are eager to hear Mr. Umesh Sarvi for his understanding and recommendations on operational requirements, advantages, etc. of setting up a fund in GIFT City. Over to you, Mr. Umesh Sarvi.
Hi, good evening, everyone. Today, my topic of presentation is setting up fund in GIFT City and operational requirements. So we'll stick with this topic. Legal and tax experts we have, so we'll not touch those areas. Let me share my presentation with you. So before talking about AIF and GIFT City, let me introduce Catalyst Trusteeship with you. So Catalyst was incorporated in the year 1997. So we are into 25th year, and we got a license to act as a debenture trustee in the year 1998. So our head office is in Pune, and we have a corporate office in Mumbai. We have branches in New Delhi, Bangalore, Kolkata, and Chennai. And the recent addition is Gift City branch, where we registered ourselves in the month of August. The products which we offer under our umbrella is AIF trusteeship, escrow agent. So escrow agent can be a one-time assignment or a throughout the life of transaction. We act as an escrow agent. We act as a debenture trustee for listed, unlisted, secured, unsecured transactions. Secured trustee for a single lender or multiple lender. We act as a trustee. We create security, hold security, and required we enforce security for the benefit of lenders. Securitization trust is again a very interesting activity where in India securitization happens in two ways, either in a trust structure or a bilateral assignment can happen. In a trust structure, we create a trust, we acquire portfolio from NBFCs or any other non-NBFC transactions also, and trust issues PTCs where various investors can invest in those PTC and we manage the entire operation of the trust. We have one more product, a loan against share transactions, where we, wherever any loan is acquired, taken, where the shares are offered as a security. So we create the pledge in a favor and we hold it till the mature transaction. And as per transaction structure, we enforce it or we release the shares. As a trustee, we have a very unique product, trustee for PF as well as superannuation trust. I believe we are the only semi-registered company who are offering these services in India. We are again ESOP trustee or employee welfare trustee. We can act trustee for these products as well. Some of the Catalyst journey till date, we have more than 1,500 clients handling more than 7,000 transactions and assets under management are more than 10 lakh crores. Again, we have the largest team in India. It's more than 115 people. In a debenture trustee, we are at number 2 position, having almost 25% market share. Securitization, we have more than 80% of market share in last 5 years. And if I'm not wrong, every month we are managing payout of more than 3,000 crore to various investors in securitization. AIF in last, we started 5 years back, and in 5 years, we have more than 100 plus fund, domestic as well as Gift City as well. Secure trustee, as I mentioned earlier, it is a product where we, on behalf of multiple lenders, we create a security. There we have more than 3,000 transactions and in various sectors like renewable energy, highway projects, real estate, or manufacturing company. So we were set up as a first non-banking private company with the SEBI, and we are in ranking. We are at number 2 position in last 3 years. From number 7, we have reached number 2 position, and we are increasing the market share every day. We have been awarded as the best securitization trustee for year 2017, 18, and 21 by Indian Securitization Foundation. Last 15 years, I guess there's only one acquisition happened in trusteeship industry where we have acquired Milestone Trusteeship Services Limited in the year 2020. And the last thing is we have set up an office in a Gift City in the month of August 2020. Now, the main topic is how to set up a fund in a Gift City. So Gift City fund can be formed in the form of trust route or a company, as mentioned by Sandeep. So, but typically most preferred route for most of the companies is a trust route. So I'll talk about how trusts are getting set up. So in the next slide, I'll mention the exact how the trusts are getting set up and entire operational requirement. Here, I'll tell you where the trust can invest. I guess Sandeep has already covered this slide. So I'll just again touch base on that particular thing. So securities which are listed on any exchanges in a Gift City, AF can invest there. Securities issued by companies who are incorporated in a Gift City. Securities issued by companies, maybe in India and foreign jurisdiction, necessary applicable laws will be applicable, which Sandeep has already mentioned there. Or any InvIT, REIT, derivative, SPV, LLP, where AF can invest. I believe separate regulation should come very soon for the InvIT and REIT, where the investment AF will invest. So we expect the regulator to come out with a specific regulation for InvIT and REIT very soon. Also, AIF set up in a Gift City can invest in any other units of AIF, other AIF which is set up in a Gift City. So how this trust is getting settled? So as a trusteeship, whenever any client approaches us, we have to set up a trust before approaching to the IFSC or SEZ. So how the trust is getting set up? So there are two parties involved while setting up a trust. One is a trustee, second is a trust settler. So as a trustee, we'll review all the necessary document. The main document is trust deed as well as investment management agreement. So once trust is settled, we have to register this trust with the local SRO office, that is sub-registrar office. That is a mandatory requirement. And once we register with the SRO, then we apply with the IFSC as well as to the SEZ for the approval to set up office in the gift city. So once that is done, we engage investment manager. There is separate investment management agreement will be executed between a trust and an investment manager, and the roles and responsibility will be defined in investment management agreement. What investment management is supposed to do with that trust. So there are a lot of operational activities which happens as a trustee. So the moment we set up a trust, we have to set up for a PAN application. PAN number is mandatory to apply for the IFSC registration number. And once we get registered with the IFSC, we get a trust will get a IFSC registration number. On that basis, we have to open a various account like bank account, demat account, custody account. So as a trustee, we will open all these accounts. Then after all the accounts and everything is in place, the investment will start happening. So that happens through contribution agreement. So whoever new investor is coming, they execute a contribution agreement with the IM investment manager as well as trustee. So we liaison with the council as well as investment manager to execute these agreements. And once the investment management agreement is, once the contribution agreement is executed, we send a drawdown notices to the investor to invest money in the fund. By this way, contributors can invest money in the trust. Once investment happens, then we regularly coordinate with the investment management for quarterly compliance report, compliance trustee report. So the format of these reports are specifically mentioned in the regulation. So IFSCA has come out with a specific format in which these compliances will happen. So as a trustee, we will ensure that all the necessary regulations has been followed and the report has been prepared in specific format. So this is day in day activity for us to liaison with the fund manager and ensure the compliances are done. Again, bank account, demat account operation is a regular activity which will happen. Whenever investment manager is making any investment, so as a trustee, we have to approve or give consent to that investment. So we check the necessary clauses in the trust deed, whether these investments are permissible or not. And accordingly, we give approval to the investment management. And there are specific formats in which this approval has to be given. And we ensure that as per the necessary approvals, necessary requirement in a trust deed, we give approvals to these managers. There are ongoing activities like every year the annual financial has to be signed. So as a trustee, we have to monitor accounts as well as tax computation. The income tax return has to be filed in a specific timelines. So we have to coordinate with the consultant as well as information memorandum, and we have to ensure that all these regulatory requirements are fulfilled within a specific timelines. At the end, when the distribution is, when the fund will start distributing money to the contributors, then again, trustee's role is there. We have recommendation letter from the investment manager, and we'll ensure that necessary tax required has been deducted or charged on the sale or income of the fund, and we give necessary approvals for the to investment manager to distribute the money to the contributors. So this is the entire operation of a trustee in a any fund. So irrespective of a category of fund, whether it's a category 1, 2, 3, 4, any category. So as a trustee, this operation will remain same. So this is from a operational background of a trust, any gift city. So that's it from our side. And if you have any question, you can get back to us in the seminar, as well as you can call us offline. We are happy to answer all your queries. Thank you so much.
Thank you, Umesh Sarvi, for the discourse on requirements of setting up an AIF and presenting the advantages as well. There are a couple of questions. Can I raise them now? Or shall I take it at the end of it? Okay, we'll take it at the end of it. Having been presented the landscape and the road ahead for business in Gift City, a deep dive would be desirable. It is said that the devil lies in the detail. As such, it is extremely important that we are made aware of the caution to exercise and to identify and to ensure all pitfalls are avoided to enable a successful business proposition. To guide us through this maze and make us aware of the significant points to be firmly focused upon, I invite Mr. Swapnil Akkut to enlighten us.
Hi everyone, good afternoon.
Yes, sir, please go ahead.
Yeah, I'm sharing my screen. I hope it's visible to everyone.
Yes, sir, it is.
Lovely. So just to give you a brief background before we go into the specifics, I'm a counsel at SNR Associates. We have 2 offices in Bombay and in Delhi. Our firm is primarily focused in securities law. And myself, I do a lot of work in the context of investment funds and securities law. And just as a brief or some interesting background, I've personally been involved quite a bit in the context of Gift City in particular. In fact, that interaction or involvement has actually helped me, deal a lot with the regulator. And before we get into the specifics, what I'd like to say is that one of the defining things that I can tell you about Gift City is that you have a regulator who is, in the regulator's own words, not burdened with the baggage of the past. What they've been basically instructed or given the mandate to do is help set up a center which is in line with the international standards, and given the flexibility to take decisions which are in the, I would say, in the interest of growth of that product as such. So that's something which I would really commend IFSCA for, particularly because practically if you've seen other regulators operating in India, you've seen a cautious approach quite often. And while that's good, frankly, in the context of a sector such as funds, which in the context of India is still growing, right? I would say that it's the right time to let these products grow as opposed to necessarily put I would say hurdles in their path. We still see some room for growth before we can start putting in those hurdles. So that's just a brief background. Let me get into the specifics now. Again, what we've tried to do is we've tried to outline our presentation in 5 key areas. Now, unfortunately, some of you might have already noticed that Sandeep did cover some of these aspects as part of his presentation. So wherever I see some form of overlap, I'll sort of skip that so that we don't need to rehash those same points. But what we've tried to do effectively is we've tried to give you an overlay of what the regulations look like and what, from practical standpoint, you can actually experience while navigating that that setup. One of the first things I would like to tell you is that in terms of AIFs in India, when you look at it, you have a relatively unified framework, right? You have SEBI as the primary regulator because these structures have been set up as trusts for the purposes of flexibility. That's essentially what trusts allow you to do. You have some element of the Indian Trust Act also come into play, as well as obviously tax considerations. But in the context of when you're dealing with a regulator, unless you're contemplating some form of foreign investment, you're effectively dealing with one regulator, which is SEBI. Right. And what that has allowed SEBI to do is it has allowed them to come out with detailed circulars and disclosures, requirements, and things of that nature, including reporting aspects, which have sort of permeated into the market. And you've realized, market participants have realized where shortcomings are there and highlighted them to SEBI and whatnot. But I would say that the framework is evolving, but because it's one regulator, I think it's easier for them to come out with solutions as well straight away. One thing which was very surprising, just before this presentation, when you're putting together some numbers, I noticed that, about 840 plus AIFs have been registered as on January 31st, 2022, which is a stark increase because, as someone who's been tracking this industry very regularly, we've seen these numbers in the range of, 450, 500 from that time. So when I look at this number today, to some extent, I feel proud to be part of a sector which is really growing and possibly has doubled since the time that I remember things have picked up pace. And that's a crazy thing. And also just in terms of context, as everyone would be aware, when SEBI came out with this framework requiring merchant banker certification, and they'd given a certain cutoff date after which essentially all new applications would require a merchant banker certification, that's led to an onslaught of a number of filings. As far as I'm aware, right now SEBI is swamped with a lot of applications. In fact, we had to burn the midnight oil several times to get some documents filed with SEBI before that deadline hit. And I think that's also going to keep SEBI a little busy, as well as we're going to see this number shoot up from 840 to possibly 1,000 plus in the next 1 or 2 months when those registrations clear. That's a good thing. Now, in the context of this framework, or what we're talking about in the context of Gift City, one of the things I wanted to stress upon is the fact that, and as everyone who's, I see some of the participants here are people who actually, set up funds themselves. Some happen to be former clients, but great. So just the context I want to bring out is that foreign investment in funds is permitted. You have the NDI rules. Before that, you have the TISPRO, regulations. But the NDI rules have a specific schedule which outline how investment can be made by foreign participants in AIFs in India, because they fall under the bucket of something called investment vehicles. Okay, and what those guidelines basically do is they effectively provide for a format or a route through which the investment can be funneled in. And it effectively also states that if the sponsor or the manager of an AIF is not owned or controlled by resident Indian citizens, or is owned by and controlled by persons resident outside India, then such AIF and the investment made by such AIF would be reckoned as indirect foreign investment. So what we're talking about effectively is a scenario where a non-resident is in some form in control of an AIF. And I would say that's the best, first and foremost, I would say, to such managers, the Gift City may be an ideal situation, because for you, this route will actually, will allow you to sidestep all of the hurdles that may come into play from a perspective of the SEBI framework, and actually allow you to interact or deal with the regulator who's more focused on solving some of the business needs. So that's one thing I wanted to stress upon. The second thing I wanted to also talk about is in a category 3 AIF that receives any foreign investment is then allowed to or permitted to make investments only in the way that an FPI is allowed to invest, because SEBI has drawn a direct linkage between these three, I would say investment routes. And that again links back to what even Sandeep was mentioning a little while ago, where you have seen AIFs that are set up in Gift City obtaining FPI registration so that they can make investments in India. So either if you're investing as a foreign investor in India in an AIF, then you're in some ways governed by the same or limited by the same investment products available to AIFs who are effectively treated as FPIs, or you can choose to get direct registration in FPI through an AIF set up in Gift City, which I would think is easier and I would say far more practical, because then you're dealing with a designated depository participant instead of SEBI directly. Then let me get to AIFs in Gift City in particular. Now, this is a little tricky, but I just want to make sure that everyone's cognizant of the lay of the land as it is right now. There is a the framework exists, but I would say to some extent it's hybrid. And the reason I'm saying this is because initially, as everyone's aware, SEBI was effectively in charge of development of the securities law framework in Gift City, right? And what they had done was they'd issued something called the IFSC guidelines in around 2015. And in 2018, they came out with detailed operating guidelines for AIFs. And what's happened is subsequently, when the IFSCA Act was notified, and in about 2020, when IFSCA itself assumed regulatory oversight, what IFSCA has been doing is it has been issuing circulars in some form, in extension or in supersession or in substitution of what SEBI has previously notified. And what we have seen happening now as IFSCA is maturing is that it is beginning to issue its own set of regulations. So those of you who've been tracking this will know that IFSCA has issued detailed guidelines in respect of issuance and listing of securities on recognized stock exchanges in Gift City, which essentially in some ways delinks whatever correlation would have been applicable to the ICDR, to the extent that anyone was intending to undertake any issuance, or to the SEBI IFSC guidelines. Because the relevant thing for everyone to bear in mind is, in terms of the IFSC guidelines, which have not yet fully been repealed, your securities laws are applicable to the financial institution operating in IFSC unless specifically excluded, right? So today, when you have IFSCA creating or issuing new circulars or guidelines, that's when your regular framework will no longer be applicable. And that's what effectively some of us in terms of market participants are also hoping for, that in due course, IFSCA will come out with its own detailed guidelines as opposed to essentially expanding upon the circulars that SEBI has issued for AIFs in Gift City. And what I think that will do is help resolve some elements of ambiguity, because as some of the participants over here will be aware, there have been a few recent changes in the way that SEBI has been approaching AIFs. For example, like I mentioned, the merchant banker certification requirement, the detailed disclosure requirements that have been, sort of made mandatory for AIFs, which has, from a personal experience, I can tell you what the amount of time that we would spend on putting together PPMs has almost doubled or tripled, right? Practically, because the level of mandatory disclosures has really increased. And these are things which, frankly, from a global perspective, may not necessarily be relevant. So that's something just to bear in mind. That's something we're looking forward to when IFSCA comes out with its own regulations. I understand that that will be something that will happen soon. So let's get now into a picture generally of what we've seen. Now, Sandeep again mentioned, as you might remember from his presentation, that at about 20 AIFs registered. I think that's more of a working number. From what I've seen on the website of IFSCA, where we've seen 14 AIFs registered as per the IFSCA website so far. I'm sure that number is in the process of being updated. But as everyone will notice, you only have category 2 and category 3 registrations, at least on the website, right? And that's also linked to the fact that a lot of these structures are being set up for investment directly in listed equity in India, right? Because FPI registration then comes as almost a fait accompli in that context. So that's something. So, but I think the fact that you have 14 plus, participants already registered as AIS in GIFT City is a very positive thing, in the sense that we are seeing other products like, for example, InvITs and REITs not have that same level of traction yet. Right. So I understand IFSCA is in the background working on preparing new guidelines or new regulations for InvITs and REITs as well. And that in due course, we'll all get a chance to see whether that sector also develops. But as funds in general, I think things are moving at a relatively faster pace today with 14 plus participants already registered. Then what we intended to do was effectively explain. So most of the people who spend some time in securities law will notice that there's a high level of public consultation or high level of involvement that SEBI seeks with stakeholders before it makes changes. So, right. So a lot of times what you will notice is that other regulators who are also comprised of persons who have worked at SEBI before start following a similar mechanism. And IFSCA in that sense is no distinct regulator per se, because we've seen that happen where they are consulting a lot with market participants to try and grow the framework. And what we have done in this slide is essentially give you some idea of how this landscape has been evolving, right? Right from the time that SEBI issued its IFSC guidelines to the time that IFSCA itself came into play, to the time that now IFSC has issued new forms and new procedural requirements in the context of AIFs in GIFT City. I'm not spending much time on this list because the next slides will actually cover some of the relevant or important updates. Let's go there. So as you'll see, one of the first things that SEBI did was when they came out with the operating guidelines. Initially, SEBI had made it almost mandatory for AIFs to obtain FPI registration. But what they have now done is they've sort of opened up the framework for investments by AIF registered in GIFT City to also invest through the FVCI route and the FDI route. As you're aware, when you're investing through the FDI route, again, your pricing guidelines and things of that nature would come into play. FVCI is one framework where those do not necessarily come into play. But again, the route for obtaining registration is a little bit longer, or rather, I would say more time consuming, because again, it's a specific set of sectors to which FVCIs can make investments. But the advantage with this circular, I would say the operating guidelines is the fact that you have investment in unlisted securities also opening up, right? Because otherwise FPIs would in some sense be limited to listed equity and obviously debt and whatnot. But primarily from a perspective of equity, it would be listed only because they're allowed to transact only through brokers. And then you have got obviously detailed guidelines that subsequently or rather tried to harmonize the investment framework, which if you might remember, Sandeep also mentioned, where by SEBI's own admission, it has now what it has done is it has linked the investment instruments available to AIFs in GIFT City with those available to AIFs generally domestically, right? I think some of the important things which actually then become relevant as benefits are now going to be covered. One of the most important things that AIF managers today will be cognizant of is that there are limitations on borrowing and leverage, right? If you're a category 1 or category 2 fund, you're allowed to undertake borrowing only for limited reasons. And again, it is 4 times a year. There's a limit in terms of 10% of the investable funds, not for more than 30 days. These sort of restrictions come into play, which are not necessarily relevant in the context of the global investment space. So what IFSCA has done, pursuant to consultations with investors as well as other stakeholders, it has opened up that hurdle, right? Where they're saying you have the flexibility to borrow. All they want is that you outline in your fund documents to what extent you're looking to borrow and undertake leverage, and you make disclosures in this regard, as well as you have a risk management framework in place. Separately, one more important thing which I think SEBI has done is IFSCA has done is they have allowed co-investment through a separate class of units. Now, again, fund managers in India will know that what in the domestic space, what SEBI has asked for is that the manager obtain something called co-investment manager certification under the portfolio management regulations. Right over here, you have that requirement completely sidestepped, which is very positive because I would say practically the concept of co-investment is gaining traction. What it effectively means is that an investor wants to double down on some investment, right? Where a particular investee company is something which an investor is particularly keen on, and they would want to increase their exposure and not have it limited only to the pro rata share. So by allowing a separate class of units, right, to be created, some form of warehousing, sort of a separate class, segregated portfolio as we call it, they are opening up this channel as well, which I think is very positive. Then also, I think one very important aspect is the fact that AIFs in India are subject to investment diversification norms. So category 1, category 2 AIF is limited to 25% exposure of its investable funds in one particular investing company, whereas in the case of the category 3, it's 10%. This has been completely done away with in the case of AIFs. So you don't even need to worry about being a large value accredited fund, for accredited investors and all of that. You have the ability to actually sidestep this investment diversification norm. Now, obviously, if you're an FPI, you'll have to keep in mind that there is a limit from a perspective of the underlying company that you'll have to comply with, because FPIs cannot have more than 10% exposure. It has to be below 10%, but that's something I would say is a subsequent element, because listed companies' market capitalization is massive. So when you talk about 10% of a company, it's a very large investment that we're talking about. Right. So let's get to the next step over here. IFSCA has also issued detailed application forms, for a person to which now you can obtain registration directly from IFSCA, where there was a little bit of confusion in the past. Now let's go forward. One of the things which IFSCA has also done is that they're encouraging fund managers who are located outside India. Like I said, this may not necessarily be a product for an Indian manager and Indian investors, right? Unless they're looking for exposure outside India. But if they are looking for exposure, within India, I would say practically from an outsider's perspective, a manager may be interested or to relocate to India if you are enabling some provisions which are, I would say, in line with global standards. One of them is the fact that the sponsor contribution or manager contribution is something which isn't mandatory in the case of foreign funds, right? When we've seen that happen, because your GPs would not necessarily put money over there the way that SEBI requests or insists upon skin in the game. So that's something which basically IFSCA has opened up the route for, saying that while relocating, you have the ability to voluntarily contribute as a sponsor or as a manager, and if you don't, it's all right, right? And then I think this is something which Sandeep spoke about, the next point, which is that RBI itself has issued a detailed circular, which in some ways settles the question that a lot of people had about the risks of round tripping when a sponsor set up a fund in GIFT City, right? Because yes, from a perspective of resident investors, the regulators aren't very keen on the money moving out of India and then finding its way back to India. But in the case of sponsors who are more likely to actually set up structures in GIFT City, there was that doubt or concern about RBI related, I would say, compliances or RBI related notices coming into play subsequently if you were to contribute to an AIF, and whether that would happen through the automatic route or whether it require government approval. So RBI has clarified that it is going to be through an automatic route. However, you need to meet certain conditions, right? And those conditions basically are that you need to be registered with the relevant authority in India. You need to have a track record of profits and obtaining approval and whatnot, right? So these are a little tricky, to be very honest. And as far as I am aware, there is a concerted effort to alter this as well. There have been representations that have been received by the regulator, specifically in the case of IFSCA as well as RBI, to sort of dilute this requirement, because practically GIFT City is a little distinct from other foreign jurisdictions, because the way that you look at it, IFSCA is actually in some form or in an Indian regulator, right? Which is not the case if you are possibly investing in a fund in Mauritius or whatnot. So the arguments that are being presented, I think, are being evaluated, and hopefully, fingers crossed, we should see a framework which does away with some of these conditions, which may actually encourage managers and sponsors from India to set up funds in GIFT City, especially if they have investors from outside. Let's go to the next point, please. These are structures that we have seen, or rather which we typically have, aware of. And I think Sandeep mentioned this, so I will move forward. But what they're driving at is, in the case of foreign investors, the Indian market is open. In the case of resident investors, where you're talking about contributors from India, the regulators are not looking for that money to come and be funneled back into India. They want that money to be moving outside. So if it's in the context of sponsor contribution, that's a different matter. But in the case of resident Indian investors, that's not something that they particularly are keen on having it coming back to India. These are some of the key parameters that are relevant in the context of various categories of funds that are set up in AIFs. You have three types. Now, broadly, some of those who are good at math would have noticed that the numbers that have been outlined in USD are actually linked directly to, or in some ways equated to, the numbers that are applicable in Indian AIFs also. So, for example, if you have a minimum corpus of an AIF of $3 million, that would come to a little over 20 crores, which is the minimum corpus required in the case of domestic AIF as well, right? And you would see something similar. For example, $150,000 would equate to somewhat a little over 1 crore, which is the minimum investment requirement in the case of an ordinary investor in India. So they've tried to align it in terms of the same sort of numbers, but designated them in USD terms. I'm moving a little ahead because practically I
Mr.
think that,
Akhod,
yes.
We'll have to look at the clock as well.
Yes, of course. I think
it'll
I'm just moving forward to the last few slides.
Yeah.
Yeah. Okay, perfect. Thank you. So again, let me come to a summary of the key advantages. The first one, like I said, is that there's no requirement on the investment diversification in that sense, the mandatory requirement. Flexibility has been given. The second one is that they have allowed them to invest outside India and done away with that requirement of Indian connection, which is a pain point from a perspective of AIF set up in India. Then the borrowing and leverage limits have been done away with. And also for the co-investment, you can do it through a segregated portfolio. I think they're the key recommend or other key benefits. That's it from my side. Thanks again. I know I may have exceeded my time, but I just wanted to dive a little bit into the more detailed aspects.
No, you're most welcome. And thank you very much for this enlightenment.
Yes.
The allure for the gift city actually emanates from taxation advances offered. All the same, taxation has always been a subject of controversy due to different interpretations based on the word and punctuation marks. We have today with us the leading experts for this dimension. I request Mr. Balaji Subramaniam to share his acute and in-depth understanding of gift city tax related issues.
Yeah, thank you for having me at today's webinar. It's a rather special day for us here at PwC. Apart from the fact that I'm here with you on the webinar today, we've inaugurated our office here at Gift City. So if any of you are in the vicinity in Gandhinagar, please feel free to drop by for a coffee or a chat. I think it'll be great to discuss, what your plans are for Gift City and IFSC, and in sort of developing this financial center in a much more broader fashion. With that introduction, I'm also conscious that we're probably just on time, but I'll try and quickly summarize some of the key tax principles that we need to bear in mind as we look to structure investments. And if you have any questions on the operational elements as well, I'm happy to take them. But let me just go through what information we've gathered here today so we can discuss it further. Now, I don't want to repeat a lot of the discussion that has already been, mentioned. As Sandeep alluded to earlier, an AIF is a person resident outside India from a FEMA perspective. So it gives it significant benefits in terms of dealing under FEMA, in terms of borrowing, etc., in terms of who the counterparties are that it can deal with. It has a lot of flexibility. But at the same time, an AIF, though it is set up in IFSC, is considered to be an Indian tax resident. So unless there is an exemption available for the AIF, the entire income of the AIF from whichever source it is obtained is taxable in India. So therefore, we need to remember that it is a tax resident from an India perspective. As was mentioned before by other speakers as well, you could invest in India under the FPI route, under the FDI route, the FVCI route. You could invest in securities in offshore markets. So there are plenty of opportunities available for an AIF, being set up in IFSC. Now, what are the key tax framework Now, for an AIF, you're probably aware already. We have Category 1, Category 2 AIF, and Category 3 AIF. Cat 1 and Cat 2 AIF are a tax pass-through. Now, typically, when it is set up as a tax pass-through, it is structured in a manner that there is no business income. We can discuss why that is and what constitutes business income, etc. Generally, the Category 1 and Category 2 investments do not have any business income, and therefore they offer a pass-through status for its investors, which is a significant advantage when you compare this with, say, other platforms such as Mauritius, where you get the foreign tax credit directly in your name because taxes are also paid in your name in India. And therefore, it becomes a key point for us to look at in terms of how this platform will sort of operate in the future as well, in terms of longevity of the platform as a pooling vehicle. If there's any business income at the trust level, then I'm using the word trust because a lot of the AIFs are set up in the form of a trust, but there are other forms which are slowly evolving, and people are considering LLP as an option as well. We can discuss that in a bit more detail. But business income are basically taxable at the maximum marginal rate. Now, in this particular budget, in budget 22, there's a new proposal introduced to exempt from gift taxation, basically under section 56(2)(7)(b), where there's a contribution made in excess of the fair market value, as determined, by an AIF. There was already an exemption available for a SEBI-registered AIF. Now that benefit has been extended to an IFSC-registered AIF as well. Now, the key difference between a Category 1, Category 2 AIF compared to a Category 3 AIF is the Category 3 AIF is taxed at the fund level itself. We don't necessarily have a look-through applied as in the case of a Category 1, Category 2. And this becomes a significant advantage, especially in the gift context, as Indian market investments are increasing significantly. What we're seeing is substantial portions of investments in Singapore and Mauritius vehicles, etc., are Indian assets, which are, on which people claim tax exemptions. Now, if your investments constitute, a large part of it is Indian investments, then seriously considering a gift platform would be in order because of the specific exemptions that have been provided under the domestic law. Now, what are the exemptions that are provided under the domestic law for Category 3 AIF? Given that it's you can invest across the world, you can, except for transfer of shares in an Indian company, transfer of Indian securities such as debentures, derivatives, etc., gains thereon are exempt from taxation in India. If there are any securities which are issued by a non-resident, not by their permanent establishment in India, then there is no taxation here in India. If there are securities traded on the offshore markets, then there is again no taxation in India. Again, participating in a securitization trust, investing in papers issued by them, again there's an exemption which is provided. MAT or AMT, as it's called for trusts, is also exempt. Surcharge on certain incomes are capped at 15%. We'll also come to the amendment that's been made in the budget in this particular round, in budget 22, in the later slides. There's also a specific exemption which is being provided in case the AIF were to borrow from non-residents, given that the leverage-related conditions have been relaxed subject to disclosures in the PPM. This is a significant benefit which is available for an AIF that is investing in India. As Sandeep also alluded to earlier, the manager entity in India is exempt for a period of 10 years from taxation out of a block of 15 years. These are 10 consecutive years. You need to make a determination in which year the tax holiday would start. There are nuances in terms of how do you qualify for this tax holiday? What is the amount of tax holiday which is eligible? That depends on each and every structure. Do we need to have people in Gandhinagar? Do you have people in Mumbai and Gandhinagar? Are these common people? Are these different people? All these questions keep coming up. The answer, there is really no thumb rule associated with all of these. It depends on the facts of each case. So we need to discuss them on a case-by-case basis. Happy to do that with yourselves. But if there is an entity which is in GIFT as a manager entity, and that would be declaring dividends under the dividend distribution tax regime, we had an exemption. Unfortunately, that's not been carried over in the current regime. So therefore, to that extent, under the classical system, there still exists taxation in the hands of the shareholders to be declaring dividends to its shareholders. GST is a major relief that's available, not only in respect of the investment management services provided by the manager to the fund, but also, if you're an FPI in IFSC investing in the Mumbai markets under the FPI route, any brokerage and other charges, custodian charges, etc., GST on that would be exempt for authorized operations which are considered as export from India to abroad. So I think that's again a key cost saver as compared to even Singapore. So FPIs in Singapore do not get this advantage, whereas FPIs set up in GIFT City get this particular advantage. Again, like I mentioned, what amount of profits are eligible for tax holiday? That depends on the transfer pricing adjustment. How do we set up our transfer pricing? Entries and the allocations between various entities of the group. I think that will play a significant role in terms of capturing the functions, assets, and risks in these various entities and locations, and advising us on how much tax holiday can be claimed. Just to quickly summarize, having a Cat 3 AIF in GIFT is as similar to having an FPI in Singapore or Ireland, just in terms of the exemptions that are offered, just in terms from a domestic tax law perspective, it's even better than the tax treaty amendments that we normally claim. And therefore, with the sort of openness with, to the various markets that we can invest in, I think this clearly becomes an attraction, especially when a large portion of your investments relate to India. Investors in the AIF, as I was mentioning, investors are taxed on a pass-through basis as if the investments were directly made by them. If you've held units as an investor for at least 12 months, then losses made by the AIF in respect of the investments in India would also be eligible, to be sort of used by the investor against future gains. If there are any treaty benefits that are available in respect of dividend income and other streams of income such as interest, then the AIF investors can again use the benefits here. Again, these are largely similar benefits to what is available for the AIF, which is constituted in the mainland as well. So if there are any income earned by offshore investors from AIF investments in offshore countries, that's not taxable in India. Last year we had the PAN and tax return exemptions notified for investors in the AIF as well, and this cuts across category 1, category 2, and category 3. Now on the right hand side, the red box here should actually read category 3 AIF investors. They're exempt from tax in India in respect of any income that is received from the AIF or on transfer of the units of the AIF, and again, they don't have to obtain a PAN, and also the overseas transfer provisions that are applicable in respect of investors in a category 2 fund do not necessarily apply to a IFSC FPI. Again, all these exemptions apply to the extent the investors are non-resident investors in the category 3 AIF. This is a quick summary of the tax rates. I would just focus on a few key elements. We will share these slides and we'll obviously discuss any of your questions in more specific, or in more detail. But the area that I want to just focus on is if you're an AIF being set up in GIFT, if there's any offshore income, and to the extent it relates to non-resident investors and the income does not accrue in India, then that's exempt. If you're a category 3 AIF and you're going to be investing in debt or derivatives in the Indian market, that is in Mumbai market or the unlisted market, that again is going to be exempt. So, it's a significant benefit that's available in terms of interest and dividends. There's a tax rate available for category 3 AIFs at 10%. So that is even better than some of the treaties that are there. That again can be used by AIFs as a, whatever little arbitrage or, just as a sweetener to the overall convenience and of being closer to the market and investing from the jurisdiction, which gives you a much better picture of your portfolio. There have been several budget proposals in the context of IFSC. Now, in the interest of time, I would probably just touch on those relevant to AIF and PMS. It's been a long request in the case of the PMS industry that when they're managing funds of foreign clients and they're making those investments in foreign countries, not necessarily in Indian securities, that the income of the non-resident should be exempt because a bank account is here. The funds are managed from an IFSC banking account, and the PM, is situated in IFSC and is also registered with the IFSC. Now that exemption has come through, subject to the fact that the investment is abroad, the income accrues abroad, and is not deemed to accrue or arise in India. So I think that's a significant advantage from a PMS perspective. We can sort of look to kickstart or further fund management activity over here. We get a lot more parity as compared to Singapore and other offshore jurisdictions in terms of managing client monies. From a banking perspective, if you're dealing with an IBU as a non-resident, not as an AIF, but as a non-resident from an offshore location, your incomes are exempt in respect of ODI contracts and OTC contracts to the extent you've earned any income on the transfer of these securities. So again, there are some minor clarifications which are requested to enable the broader gamut of transactions under the OTC and the ODI derivative contracts. In the interest of time, I'm not going to get into the details of it, but happy to discuss that offline. Ship leasing has been given tax exemption, several tax exemptions, and has been enabled in this particular budget, as was done with aircraft leasing last year. So again, kudos to the IFSC and the GIFT management in sort of having these discussions with the government and enabling these business activities over here. Other budget amendments, I would probably not get into too much of detail of that, but there is a reduction in the surcharge which is available in the context of, say, interest of a category 3 AIF, which is investing in India. The higher surcharge, which was then applicable prior to this budget, was 37%, which has now been restricted to 15% in the case of an association of persons where only companies are its members. So we need to see the fact pattern again, but this is again a good amendment to sort of bring it on par, with taxation of other forms of income such as short-term capital gains, long-term capital gains, and dividend. There is bonus provisioning, bonus stripping and dividend stripping provisions which have been introduced. In the interest of time, I'll probably not go into the depths of this, but I'm happy to take your questions and then answer them. But I'll hand it over back to the moderator.
Thank you, Mr. Subramaniam. And first of all, congratulations for your commencement of GIFT City operations, for bringing clarity on this subject. I do understand that there has been a time pressure and some of the things could have been more elaborate, but that will be for some other time. Now we are coming to the most important aspect of the webinar, that is of onboarding the investor. The entire purpose of this exercise is to get investors. And for this important segment, I request Jayesh Khaitan, who has been very patiently waiting for us, to offer his insights on the investor onboarding, eKYC, fund accounting, fund compliance, as the ultimate purpose for the entire exercise is to create synergies. Mr. Jayesh Khaitan, the floor is yours. Mr. Jayesh, you are on mute, I think. Please unmute.
Yeah, thank you, Mr. Shashank. And Sorry, yeah. Hi, everyone. Thank you for joining today's webinar. It's been an extremely interesting last year for the fund setup industry in GIFT City. Guess, introducing this appealing new fund structure with excellent tax incentives, which have been modeled on international best practices and really designed to attract institutional capital. And now, more and more funds coming to the setup GIFT City, attracting ray of light. It shows that there is a huge benefit, and having your fund set up in GIFT City, it's really supporting the entire ecosystem, ranging from the service providers to the investment managers. I'm going to take today role of fund administrator. So to start with, what is a fund administration? A outsource of support function, typically comprised of three parts: fund accounting, registered transfer agency, compliance. Fund administrators are specialized in specific investments like hedge funds, private equity, real estate infrastructure funds, venture capital, family office, and now digital asset funds. So RBI will give opportunity for digital asset funds, and administrators are ready for that. So I have categorized in several categories for ease of reference. So to start with fund accounting, the most important is a trade capture, maintain the books of accounts, bank and portfolio reconciliation. So the team will be reconciling bank and the portfolio. Security pricing as per the PPM. They are expert. They go by the PPM and they do the security pricing. Assisting in the corporate action. And the most important is calculating the net asset value of the fund, determining managers' fees such as a management fee, performance fee, and carry interest. In a way, investor manager can bypass the conflict of interest, calculating his own fees, as well as the relevant accounting framework that has been adopted, the new common framework that are commonly used in the India Financial Standard, that is Indus, then International Finance Reporting Standard, IFRS, and the US GAAP. Just for your information, business are allowed to adopt either this framework. And then in the next category of the treasury. So we'll be managing the funds bank, and administrator will be able to assist you with the payment services to facilitate your cash transfer, make payment for fund expenses, including payment of reimbursement of fund managers. In terms of the control of the bank account, it can be helped by defined administrator, or it can be like a joint account, joint mandate, which will create a better governance. So from fund accounting, trade capture, net asset value calculation, financial reporting, and then treasury. So all will be taken care by the fund administration in the GIFT City. So next category is transfer agency, which is like investor servicing. So subscription, redemption, capital call, share registry, customer due diligence. That is very important when you are onboarding overseas investor, the due diligence of your investors. Investor communication, sending all the reports to the investors, NAV statements, capital call, and distribution and waterfall. So teams, fund administrator team are very expert doing all these activities. And they are expert and experience in the private equity, venture capital, hedge funds. So it's give a solution to the investor manager. And fund administrator will be taking care of compliances also, regulatory compliances, which like quarterly compliance and TCR. At present, SEBI compliances are falling in the IFRS also. So the moment we will have the IFRS separate regulation for the compliances, that will taken care. So the next category over here is tax reporting services. So FATCA, that's very important and challenging. In the fund general, IFSC will be subject to the US FATCA reporting and CRS reporting. The service can be provided by defined administrator to perform the required due diligence on investors and perform the reporting at the end of each year. So registration as well as every year return filing for the FATCA and CR. And so provide you the K1 reporting also. If there's a US investor, the administrator will be able to provide you K1 reporting. and the prefix statement for your investors. So going to the next category, which is investor onboarding. When you have an overseas fund, which is Gift City fund, your investors are also overseas. You need a platform to onboard them, maybe individual or corporate. So we are providing a system where all these individual or corporates can log in, they can upload their KYC, and we can then from directly from that system itself, fund administrator can assist funds and funds manager in the performance of the customer due diligence. They can have the relevant procedure and resource in the place to meet these regulatory requirements, particularly in the identification and the verification of the investors. So detailed due diligence for the investors. And this system is available 24/7 to the investor manager. They can always keep on checking that what is the status of their investors and the signing of the subscription agreement also. So contributor agreement will be signed also online, and that will also be available to see online. So fund administrator as a sparring partner, what value we are bringing in the table to the investor manager. When you are setting a fund, some of the consideration that fund administrator can guide you. Getting your fund administrator involved in the reviewing of offer documents will help you to ensure that is a legally and operationally sound, such as your offering term, including the subscription and the redemption terms. The practical of this deadline, the equalization that you see in the close-ended funds. So all these offering terms can be vetted, can be reviewed and by the administrator. So you will be in the same page, and practically you can also check what are the timeline to be complete all these offering terms. Coming to the fund structure, in terms of the investment strategy, whether open-ended, close-ended structure could be a more suitable, whether you may choose for a feeder structure, master feeder structure. So we can discuss administrator with our previous experience, what structure can be more suitable to you. And offering of the different share classes to the accommodate different terms of the investors. Valuation policy. Your administrator can help you with your valuation policy of the fund and ensure it is in accordance with the relevant accounting framework. So all these can be vetted, review before launch. So it's sharing our experience. We can judge all the, we can all check all the documents. We can set the timeline for all these. So coming to the management fee as the market standard in terms of the manager's fee, you know, mainly for the performance fee, you see the equalization accounting versus your series accounting. So what type of management fee you will want to set? Fund administrators are familiar with this type of structure and they will be able to advise you on that. Coming to distribution, the other features are like distributing, how you are going to do the distribution to your investor. If you are going to pay out dividend out of income, or your distribution may be out of the capital as mentioned by earlier. So I'm just going by one by one and taking one or two examples where how we can, as a partner, can bring value for you. FATCA and CRS, your fund administrator will be able to help you for apply your GIN and FATCA. Already we have covered earlier. And same thing, bank and custody account. They are very familiar with the bank. They have a good relationship with the banks. So it will be easy to open the bank account in a faster manner. Other aspects is reporting. So financial reporting that we have talked in earlier slide, IFRS, India accounting standard, or US GAAP. So by that, fund administrator always help to the investor manager. Benefit of outsourcing. So what are some benefits of outsourcing to the fund administrator? So the first point I would like to highlight, that is independence. Since fund administrator have robust control and generally have their process undergo a SOC audit, and they are increasing sophisticated and the institutional investor demanding for independent fund administrator, because we are going through by one audit. So it makes sure that whatever we are doing, what all are the activity, there's no involvement of any other party. That's very fair. And because of that, there's a lot of demand from the HNIs and the overseas investors, Indian investors, that fund administrator should be independent. As well as fund manager can be more focused on their core activity. The second point, fund manager can be focused on their core activity, such as, trading, assessment of investment, raising capital, and not we think about the administrative matter and regulatory reporting, because we will take care of all your non-core activity. Technical expert wise, fund administrators are well versed with the relevant fund operation and asset classes. So they have a technical expertise. They know that what is the timeline for your regulatory reporting, for your accounting, for your tax return filing. So everything go by the flow chart. There's a team, they divide their role and responsibility. Then coming to the leverage on the administration technology, that is very important point. But that we are, as I said, using a Paxes for the fund accounting, and we have a robust software for investor onboarding. Fund administrator to perform your fund accounting as well as AML requirements for a specialized accounting system. They are actually costly, not only due to your vendor cost, but also time and other costs to support to use the training of such system. So manpower skill, administrator have their team, they know they are skilled to use this technology. They know how to use and how to make more new technology and more new system to make it everything automated. Country of services important for daily and weekly traded funds. So there's a team who, if your funds are daily or weekly traded funds, do you want daily NAV, weekly NAV, all can be taken care by team. So thank you. This is from my side, and handing over to Mr. Sasank.
Thank you, Mr. Jayesh Khaitan, for your presentation from the investors' perspective. With this, we conclude the presentations, having covered all the major aspects. Well, we would have liked to keep the floor open for many questions to be raised. It will be appreciated that we have already overrun the time. The spillover has been significant. So symbolically, I am taking a question each for each of the presenters. So Mr. Jayesh, I just like to know from you, this is a question that has been raised, what role technology will play in fund accounting?
Yeah, thank you. That's very important. Nowadays, you can say that we are going by technology. If it's a banking also, if you remember old days, we are used to go for fixed for depositing our cash to the bank. Now no one goes to the bank for depositing their cash or withdraw their cash. Everything is online. So same thing. Now, if you see the AIF industry, not only India, globally also, all the investor manager, all the investors also, they would like to make it automation. They want to use the robust software. It's very easy then for data sharing as well as. It's very easy to generate different kind of reports. So yes, from the investor onboarding, checking their AML, checking their identification, and going to the accounting part, doing their accounting as well as all the compliances. So it's all day by day is getting by technology, and that make convenient for everyone, convenient for the investor manager, convenient for investors to see different kind of reports. It's very easy to take the decision while seeing the reports, because see, after your investments, there's a lot of data start playing, and after seeing that reports, you can make more different decisions. You can manage different kind of funds and different funds also. Now, if you see, and I'll not take, I'll take just 1 minute. There are funds who wants to invest in different jurisdiction also. They want to invest in different countries. It's all by system. It cannot be possible without system. So technology is playing very, very important role. Thank you.
Thank you. Thank you. It does improve the perspective and the range of investments and issues that can come up if the accounting is not, technology driven. Thank you very much for your inputs. I'd request Mr. Balaji, if there's a question, what is the benefit of setting up a category 3 AIF in IFSC as compared to having it in Singapore?
Yeah, so that's a good question. So when an entity claims tax holiday or tax treaty under the India-Singapore Treaty, there are anti-avoidance rules which become applicable. Though we might say that we get the same benefit under the India-Singapore Treaty, accessing that under the domestic law becomes much more easier and slightly more difficult under the treaty. And therefore, some investors need to be cautious and what they're signing up to at the Singapore entity level, and the Singapore platform also need to be aware of the requirements under the Indian anti-avoidance rules, which is GAR, and the multilateral instrument, which contains principal purpose test and other rules in terms of whether the exemption is going to be available and what is the strength of our particular situation. So therefore, it becomes quite key for us to understand that domestic laws themselves offer a much better tax regime as compared to the treaty. And given, several players have portfolio managers and traders and professionals sitting out here, it's easier to access and scalable and clearly more cost effective to do business here.
Thank you, sir. Now we'll have one question from Mr. Umesh Sarvi from Catalyst Trusteeship. Whether AIFs in GIFT City are permitted to make investment in overseas companies?
Yes, absolutely. Because since this AIF is considered to be non-resident of India, so definitely it's free to invest in any overseas companies. So there are no separate regulatory approvals are required for this. So I think it's very much possible.
Thank you. I have a question for Mr. Swapnil. Is there any limit on the leverage AIF can undertake in a GIFT City?
Right. So just as I explained during the course of the slideshow, the regulator has given flexibility to basically the AIFs. However, they are required to make sure that one, they made the necessary disclosures in their draft PPM in their PPM itself. Subsequently, there is a consent obtained from investors, and most importantly, they need to have a risk management framework in place. So long as you have these three conditions complied with, you're free to go beyond the limits that have been outlined in the context of domestic AIFs.
Thank you, sir. Mr. Sandeep, I have actually two questions for you. One is, if we have set up an AIF outside GIFT City, how can we take benefit of the GIFT City? And the second question, okay, please go ahead.
Yeah. So basically, there are two aspects. One, if you set up AIF outside India, not within the country, then you have opportunity to relocate that fund through the relocation framework and the regulatory and tax framework. And if the fund is set up within India, basically, in the domestic territory of the India, where if you want to take the advantage of GIFT IFSC AIF regulatory framework, then what you can do is you can use the existing fund manager license issued by SEBI to set up a branch in the GIFT IFSC. And for the fund, you will have to set up a new fund basically to raise the money from the overseas investors. So the one major advantage, if you are a registered fund manager in India already, you can create a branch structure instead of creating a new company or LLP.
Thank you, sir. And one question from my side. What is the aspirational position that is being targeted to by GIFT City? And how do you view the progress made so far in that direction?
Sure. I'm sure this is more from the overall GIFT City perspective that you are asking, right?
Yes, sir, yes.
Okay. So the main objective for setting up the International Financial Services Center at GIFT City is to create the international financial gateway for the country. As I'm sure you all know, the earlier majority of the financial services business were being done through the other global financial centers like Singapore or Hong Kong or London. Now with the available regulatory framework in India, where even the international financial services can be carried out. Our objective is to ensure that at least India related business, where India centric funds or the requirements of the Indian corporate should be served by the entities set up within IFSC. And eventually the center should also become kind of a gateway for other countries as well to serve their international financial services requirement. The progress has been quite impressive if we consider for last 1 year, where we were only 120 or 130 entities which were set up 2 years back. Now the number has reached to kind of more than 300 entities. And going forward, we are expecting at least 50 apps to set up their shop in next 6 to 8 months, and subsequently we are expecting growth in all the business segments. So I think we are on track, and with this now new regulatory and tax enablement, we expect a huge growth in the financial services sector in GIFT City.
Thank you, sir. I think we have practically covered the entire gamut of aspects that relate to the GIFT City and more specifically on AIF. I believe that India is in an ideal time zone between the West and the East. It can commence service with the opening of the Japanese markets and end its day with the closing of the US markets, thus operating for nearly 22 hours a day. That is the potential that we have. The central and the state government, SEBI and IFSCA, the regulatory authorities have been very proactive and supportive in addressing the concerns that arise on the path of progress of the GIFT City. We thank them for creating and constantly nurturing the idea of GIFT City that is still an ongoing implementation exercise of bringing the nation up to speed with international financial markets. We thank our partners, representatives, Mr. Sandeep Shah from GIFT City, Mr. Swapnil Akut from S&R, Jayesh Kaitan from the Ascent Group, Mr. Balaji Balasubramaniam from PwC, Mr. Umesh Sarvi from Catalyst Trusteeship Limited. My special thanks again to Ascent Group, Mr. Jayesh, whom I have interacted in the last couple of days for a longer time, and for the assistance that he is providing in enabling this webinar. There have been a huge number of questions. Obviously, we couldn't take them up because of the time constraints. We assure each and every of the participants and attendees that we will be responding to their queries in a couple of days. Please bear with us. Thank you all once again for this excellent webinar, which I think will be a trendsetter in coming days to have more and more webinars as the details need to be fleshed out in greater detail. Thank you very much. Thanks to all the participants and the attendants and the expert panelists for this precious time. Thank you.
Thank you.
Thank you.
Thank you,
Thank
Mr.
you.
Shashank.
Thank you.
Thank you.
Mukherjee is very